What jumped out at you the most in the data?
Everybody's been paying a lot of attention to renewal of mortgages, and that is certainly going on. But then we're also seeing how Canadians are trying to cope with that renewal wave.
Canada has long carried one of the highest debts in the G7. Has that changed at all?
It's good that it's not increasing dramatically, but the level of household debt is a serious concern. It's bigger than the size of the economy.
So what's the overall picture for borrower stress heading into 2026?
Well, I think overall, if the macroeconomy holds steady, and Canadians have so far been quite resilient with respect to the macroeconomy, I think the overall picture is relatively stable.
You're listening to In-House, Canada's housing podcast, where we share the latest on Canada's housing market. Hey everyone, welcome back to In-House. I'm your host, Joelle Hamilton. So today we're talking about the Spring 2026 Residential Mortgage Industry Report, or the RMIR for short. And it's one of those reports that's packed with insights, but we're going to break it down and make it a bit more digestible. And I'm really happy to have Aled Iorwerth back in the show. He's one of CMHC's Deputy Chief Economists and is always really great at helping us make sense of what's going on in the residential mortgage industry. Welcome back, Aled.
Thank you. Good to be here.
Got a lot to talk about. But before we dive into any of the numbers or kind of concrete details, what jumped out at you the most in the data?
As you say, there's just so much going on. I mean, everybody's been paying a lot of attention to renewal of mortgages, and that is certainly going on. But then we're also seeing how Canadians are trying to cope with that renewal wave and adopting different strategies, moving to variable rates, which we'll get into a bit later. And so there's a lot of those dynamics. But I think this is also happening against a backdrop of a little bit of uncertainty in the macroeconomic context. There's a challenging international situation. And so at the moment, we're seeing Canadians being resilient with their mortgages. We have concerns. Delinquency rates are going up, particularly in Toronto and Vancouver. But overall, the mortgage system seems strong, robust, but worth monitoring and worth paying attention to try and make sure that risks are contained.
And I feel like we've been talking about renewals or that mortgage renewal wave for at least a few years now. Where do things stand now going into 2026?
Yeah, so I mean, everybody probably knows the story, but a lot of Canadians took out mortgages 2020, 21, 22. Those are now into the Canadian system with a traditional 5-year term for the mortgage. Those are now coming up for renewal. And then people have been opting for shorter terms as well. And again, those are coming up for renewal. So I think we had something like 1.5 million or something Canadians renewing their mortgages. And so I think we're past the peak of the wave, or whatever the appropriate metaphor is. So I think that overall wave has passed. Now, there are still risks in the system, maybe particularly given uncertainties over interest rates, and interest rates may be quite a bit higher. There are risks still in there. And so, but I think we've past the peak of the renewal wave at the moment.
So, Aled, in the fall 2025 report, borrowers were shifting back to fixed rate mortgages from variable rate mortgages. Is that still the same this spring?
Well, what we're seeing is that Canadians are choosing a variety of strategies. They don't know which way interest rates are going. There's a lot of uncertainty, as I said, on the macroeconomic side. So I think they're just exploring all sorts of options to address or to try and lower their interest bill. So some are, and to do that, they're having to predict where the economy is going, and so they in this complex environment, they're developing a range of strategies. Some think perhaps that interest rates will fall, and so we'll be moving into more variable rate mortgages. Some people are saying, well, we're not really sure what's going to happen, but there's a lot of risk, but we want the certainty of mortgage payments for the next year or two. And so they're moving to, periods of 2 or 3 year fixed rather than the traditional 5 year fixed. So Canadians are having to and are exploring a whole range of strategies to try and address this uncertainty over what's going to happen to interest rates and the economy. And that's leading to a much more complicated mortgage structure, particularly in this period of less than 5 years that Canada traditionally has had.
So you touched on this a little bit in like kind of the brief overview of what stood out most in the report, and it's about rising delinquency rates. Has that trend changed at all recently, or is it still continuing that trend up?
It's continuing to trend up now. We have to be a little bit cautious about interpreting the numbers because, on the one hand, the rate of increase is quite high, particularly in Toronto and Vancouver, where a lot of the housing affordability stresses have been happening. So the rate of increase of delinquencies is increasing. Now, on the other hand, the delinquency rate is not particularly high by historical standards. So if we go back to the pre-pandemic, pre-COVID era, delinquency rates are still within normal bounds. They've increased a lot because they were actually quite low. So, but it is, again, something that we're monitoring very closely because the uh, people, if they can't pay their mortgage, there are significant problems. So it's something we're monitoring, and it's a little bit of a concern that it's going up so much in Toronto and Vancouver in particular.
Now, I want to take a deeper dive in stress that could be building, under the surface. You mentioned that we're watching specific like indicators like the rise in delinquency rates. But I want to just step back from mortgage numbers and percentages and all that. And where are we seeing signs of borrower stress or labor market weakness? And like what risks does that pose?
Right, and so again, I've sort of been hinting at
Yeah,
at the
yeah.
macroeconomic situation for quite a while, and the real struggle is if there is widespread loss of jobs by Canadians. If a household loses its primary income, loses its labor income, they will struggle to pay the mortgage. This is to a certain extent a normal part of the economy. But if there is are widespread job losses, then the whole system starts to struggle. We're not at that stage yet, but we are monitoring it very closely. And one of the key indicators for us is the unemployment rate. So if the unemployment rate were to spike significantly, it's already a little bit high in Toronto, but if the unemployment rate were to spike significantly, that would be a cause of concern because it would mean a lot of Canadians were not able to service their mortgage.
So I think based on the report that if I look here, the national unemployment has reached 6.7% in February of 2026. So it'll be really interesting to see when you come back to talk to us about the fall rental market report where that number lies. Has it increased? Is it stabilizing or has it decreased? So we'll watch for that.
Yes, absolutely.
So you mentioned also that non-mortgage delinquencies were rising, and can you explain exactly what you're seeing there and why it matters for kind of the mortgage system in as a whole?
Right. So Canadians have a wide range of debt that they have. They have credit card debt, they have auto debt, they have mortgage debt. Our concern principally at the moment is with mortgage debt, but in order to try and understand what's happening in the mortgage system, we look at those other types of debt as well. And as probably everybody knows, if there is one debt that you really need to pay, it's your mortgage, it's your home, it's your dwelling. And so safeguarding your home is obviously a primary interest of all mortgage holders. Now, So servicing the mortgage is critical. And so Canadians in general, if they do run into financial difficulties, they will start to stop paying some of the other debts, credit cards, car loans, and so forth, perhaps student debts. So it's important for us to try and see what's happening to those other debts, because they may be an early indicator of warning of something not going well in the mortgage system. And when we do look at those other debts, it's again a little bit of a mixed picture. The delinquency rate, as you were saying, are going up. Now, on the bright side, they are going up at a slower rate than previously. So it seems that there are challenges in those other lending products, but um, it's not deteriorating as much as previously was the case. So it's a little bit of a silver lining, but again, an area that we will continue to monitor.
So, speaking of household debt levels, which you really touched on, Canada has long carried one of the highest debts in the G7. Has that changed at all?
At the margin, yes. I mean, it's been, but when you're talking about numbers that are so big, I don't know that it's a meaningful change. It's good that it's not increasing dramatically, but the level of household debt is a serious concern. It's bigger than the size of the economy, and longer term, it's a real vulnerability if, again, interest rates were to increase substantially.
So, what's the overall picture for borrower stress heading into 2026?
Well, I think overall, if the macroeconomy holds in, and Canadians have so far been quite resilient with respect to the macroeconomy, I think the overall picture is relatively stable. I think the mortgage system overall is working well, but there are pockets of stress that we are looking at. So, for example, the delinquency rates are high, increasing in places like Toronto. That's an area of concern. Some of the lenders, the mortgage industry entities, delinquency rates seem to be quite high, but they're a small part of the overall lending system. So there are these pockets of risk around the place. The overall system seems okay, but I think we're continuing to monitor those pockets that I mentioned.
So, just to wrap up, is there, one structural signal that you're watching more closely than others?
Well, the unemployment rate is one of the critical ones, but we're also really going to try and dig into the some of the delinquency rate at the local level. So, what is going on in Toronto and Vancouver?
Well, thank you so much, Aled, for joining us today and for walking us through kind of the key findings and key insights of the residential mortgage industry report. It's always a pleasure to have you in the studio, and I'm looking forward to having you again when we look at what the picture's telling us in the fall. And thank you to our viewers for joining us in-house. See you next time. Did you know we're not just on YouTube? You can now find us on Spotify, Apple Podcasts, and Amazon Music. Don't miss our next episodes for more real, data-driven discussions. If you're learning from and/or enjoying this podcast, please share this episode, follow us, or subscribe. Reach out. Let us know what you think. Thanks for listening, and see you next time.